David Bahnsen joins us here in Studio 2, the Chief Investment Officer at the Bahnsen Group. All right, David, let's start off first with the rally. And I mean, this has been a phenomenal rally. We're 3 years roughly into this bull run, depending on how you want to measure it here. And there doesn't appear to be anything major standing in the way. I know there's a lot of risk out there, but no one's really pointing to this and saying, look, this is all just going to burst and come crumbling down in the next few weeks. Although you're smiling, maybe there is something.
Well, I think there's two things, and you guys just said one of them. You said, thank God for NVIDIA. You just can't have a rally that lasts because a $4.5 trillion company is going to become a $5.5 trillion. I mean, at this point, would anybody be happy if NVIDIA is up 10% in the next year? That'd be a subpar return. Yeah. But to get that, it has to add $500 billion of market cap to get a measly 10%. So I think that the fact that it's so dependent on what has become the S&P 10, 40% of the market, and the S&P 490 at 60%. I did a thing for my dividendcafe.com today. In 1985, the top 10 companies were 10%.
Wow.
Then in 2005, which is an ancient history, it was 20%. But it's quadrupled in 40 years.
But we've been through these cycles before where we've seen market concentration like this.
Not like this. We've never seen it this high.
What happens? What happens? Like historically, what typically happens? Is it sort of an orderly unwind or is it a crash? I don't know.
If you look at the two major ones in the 25 years I've been professionally managing money, .com, you had all the big ones drop the most, and then you had a rotation and other names came up. And so you got back to a reversion to the mean both ways.
Okay.
2008, everything dropped. It's just that the more expensive stuff dropped more.
Okay.
Well, you referenced, when it comes to some of the levels of concentration that we've seen, a more normalized makeup isn't ancient history. We've seen it in the not too distant future, but is it history? I mean, do you see that this could potentially change this dynamic where it's just a few names that are so enormous? Or is this just something we're going to get used to?
No, we're not going to get used to it because this is a basic economic principle about things, how much they can grow, earnings growth, valuations. The sentiment around the earnings growth is the largest driver, not that fundamental earnings growth. The earnings growth has been huge, but that accounts for $1 trillion here, $1 trillion there. But you get an 80 times multiple. At some point to grow into that, it takes years and years. The vast majority don't grow into it. Some have. The Googles of the world have grown into it. But I think that the entire AI story will become a very, very interesting deal, add to a lot of volatility in 2026, because you're going to have winners and losers and a lot more vol than people realize.
Well, David, I hear what you're saying, that, the hope there is that these companies will grow into their multiples. The natural next question is, what is the catalyst for investors to say, enough is enough, you're clearly not meeting the sky-high expectations?
The problem with it is, the reason I don't know the answer to that is because there's been different catalysts in history. Ultimately, there isn't a ton of leverage behind this, so you don't get forced selling, but there is some leverage. But again, valuations sometimes just get to be too much, and selling begets selling. Now imagine an announcement. I'm not saying it happens this quarter. I happen to think it won't be. But there is a quarter coming where a Microsoft, one of these hyperscalers, says, we're scaling back our orders. This CapEx has been too high. What is the trickle-down effect of that? How many companies are intertwined in this story right now? I think that there's a lot of adjacent sectors that get taken with that as well.
Well, on that intertwinedness, I mean, we talked a lot about this when some of those deals, these AI deals were being announced, and kind of the circular nature, right? NVIDIA takes a stake in this company, they buy NVIDIA chips, and then NVIDIA buy, it's like, okay, whatever. I understand that we've seen this type of incestuousness before. But is it of concern, I guess, the idea that if something were to break down, it truly would be a true ripple, almost systemic effect?
I don't think it is to ripple into consumer staples. I don't think it has to ripple into healthcare. That's why I make the example of 2000, when large cap value was up in a year where the NASDAQ had been utterly decimated. A rotation is much more likely in that scenario. But when you say we've seen this incestuous nature before, I think you're right. There's been a lot of stories. The financial crisis, we thought it was housing. It turned out to be credit and this and that. No. Not with this many zeros and commas. Have we ever seen this kind of incestuous nature? The triangular deals whereby companies are putting money into companies who are putting money into company who give it back to them. I've never seen anything like it. And investors will care at some point. They don't yet.
incestuous, triangular, circular, overlapping. There's all these different ways that you could describe what's going on in the deal making and the partnership landscape in AI right now. Let's talk a little bit, though, about the Fed, because you write in your notes that one of your messages to investors is do not create an investment policy right now that is trying to front run the Federal Reserve. What does front running the Fed mean to you at this moment?
Well, the idea that someone says, oh, the Fed's about to cut rates, I want to go lay risk on because the Fed's going to, if anyone thinks that the markets don't know that the Fed's going to be cutting next week, they're going to cut again in December. I think we have Fed funds futures right now that are at 98% on the next 2 rate cuts. You're right that there is probably some question about 2026. I don't think that investors are looking to do that. But what I'm hearing a lot of people say right now, I want to put risk on because the Fed's going to be cutting rates. And what I'm saying is I think valuations have reflected that for quite some time. Don't try to get in front of the Fed. Right now, my bigger question is like summer of 26. After Jay Powell's been replaced, at that point, let's say the Fed funds at 350. Are they going to go down to a 2-handle? What are they going to do with the balance sheet? Those things matter more into the future for financial conditions.
Yeah, certainly so. And of course, at a time where a lot of people look at financial conditions and say they're not necessarily all that tight right now, at least not to warrant, 5 rate cuts, whatever the market is priced in. David, great to have you. David Bahnsen, Chief Investment Officer at the Bahnsen Group.